Well, good day everyone, and welcome to our May 2023 video report. I'm Dion Zukiwsky, branch manager and portfolio manager here with you, and spring has finally arrived. The big question now is, will your portfolio continue to bloom? In today's update, of course, we'll check into strategy, as well as what the heck is going on in the banking sector in the United States. Is that going to affect us in Canada as well? And later, we'll bring in associate Bond Jewell, who's going to review safety of deposits with big institutions like us here at Scotia. So shortly after our last video, there started to become some serious cracks in the foundation of certain regional banks in the United States. Due to many factors, ranging from poor deposit management to higher risk lending, the worry was that these regional bank issues may have a contagion effect with the larger ones. For example, First Republic Bank in the US is the latest to fall, and we'll look at a chart here. So what we're looking at here is some of the largest US bank failures that have happened over the last 30 to 40 years. The worst we ever saw was Washington Mutual at the height of the financial crisis in 2008. But recently, First Republic Bank, Silicon Valley Bank, and Signature Bank all have went under as well, carrying with them some pretty significant deposits. Now, the good news is a lot of these banks have been taken over by larger ones. And in fact, they've also been supported by the US Deposit Insurance Company. But one of our big concerns is, could this happen to us here in Canada as well? It seems to have settled down in the United States for now, but could this happen up here? We think it's unlikely, and here's why. First, in Canada, we have a much tighter regulatory system for banks than there is in the United States. In the States, quite honestly, if you have a group with enough capital, you can start your own bank. In Canada, it's much different, where there's higher requirements for the backing of deposits and loans. And here's a great chart that we'll show you to explain more. Canadian banks actually boast some of the most healthy liquidity ratios in any banking around the world. The big six banks in Canada all have over 100% in liquidity coverage ratios, which just means if they have to convert assets to cash to satisfy any withdrawals, that money is there. In fact, the Big Six average is at 137%. Compare that to some of the US regional banks, and they were only backing 25 to 30%. The other big factor is size. To compete with the Big Six Canadian banks, it is very difficult for a new entrant. Not only to work within the strict guidelines I just explained, but keep in mind that the Big Six have over 93% of all banking assets here in Canada. Finally, the conservative business nature and the lending models also protect Canadian bank depositors. This was criticized years ago for being too conservative. Then after the great financial crisis of 2008-2009, our system was then heralded as one of the best. And a good comparison is with commercial real estate loans. Canada's Big Six banks have about 10% of their total loans in this area, where small US regional banks carry an average of 25%. So our system is indeed on solid footing, and we've actually been adding investments to this space selectively where we can. Switching to strategy, moving forward into the middle part of the calendar, what does strategy look like for us? Well, it's kind of like me on a paddleboard. Maintaining careful balance is super important. I don't know about you, but anytime I try and paddle too hard, I hit the water. And that's where we are today as investors. We don't want to paddle too hard, try and get too much return, because we've had a good start to the year, but we may see a bit of a pause going forward. That's because the full effect of those higher interest rates are still working their way through the system. And Scotia is keeping a base case of a possibility of a mild recession coming up. Although it's nothing to lose sleep over, there could be potential for some headline risk here in the near term. On the positive side, we're still seeing strong opportunities in areas such as fixed income or bonds, along with adding alternative investments like private equity and real estate. Equities, or market investments, should see another leg higher in the second part of 2023, when it's predicted that interest rates will either plateau or even possibly move down a notch to keep the economy moving forward. Of course, if you have specific questions about your strategy, give us a call anytime. It's our job to help. Now, with all this talk of safety, let's bring in Bond Jewell, who will explain how your investments are backed here with us at Scotia.
On today's Did You Know segment, we'll be discussing the Canadian Investment Protection Fund. The CIPF for short ensures that all non-registered accounts combined, as well as combined registered accounts, including all our RESP accounts, are insured up to $1 million in the case that the member firm in which they're held were to go insolvent. What exactly does this mean? It means that your securities, including cash balances, are protected in the case that that firm were to go insolvent, up to $1 million. For example, if you held 50 shares of Canadian Tire Corporation and the member firm in which they were held were to go insolvent, like we saw last quarter in the US, the CIPF would ensure that you either received those 50 shares of Canadian Tire Corporation or the value of those shares on the date of insolvency. If you have any questions or concerns with regards to CIPF, please feel free to reach out to our office and we'd be happy to walk it through here with you. That's everything. Thanks. Have a great day.